Thank you to all of you for joining us here this evening. What we decided to do this year is take a professional issues update around to all 15 of the Society's chapters. So this is our 12th presentation. So hopefully we've got it down right by this time. If not, you let us know. And it's usually a 2-hour presentation, but the chapter leadership has asked us to condense it into 1 hour for your presentation. So we're going to be talking very, very fast, and we'll cover as much as we can within that hour. But please feel free to jump in and ask questions or save them for the end, whatever you feel most comfortable with. So what we're going to be doing today is we're going to try to cover as much as we can in 4 particular areas. I'm going to be talking about legislation and regulation, and Harold, our current president, is going to be talking about generational issues within firms and some firm data in terms of how New York compares on a national level. And then if we can squeeze it in, we're going to talk a little bit about the changing nature of the audit, but often that's the piece that we don't have time for, so hopefully you'll get enough information out of the rest of the presentation to make this worthwhile for you tonight, and it is 1 CPE credit for all of those of you who are here this evening. So let's start with the legislative and regulatory update. We believe at the Society, on the staff side and on the leadership side, that advocacy is the most important thing that we do for you for your membership dollars. Unless you're with one of the very, very, very largest firms, most firms do not have the resources or the desire to focus on hiring their own lobbyists and getting actively involved in the advocacy area. So because we can do that on your behalf, all of our members benefit from the advocacy programs that we have in place. So what does that look like? We have a 3-pronged approach to our advocacy program here at the New York State Society, 3 different buckets. The first bucket is our Political Action Committee. If you have been at any of our Society events, you've heard about our Political Action Committee. That's the venue through which we raise money from our members for the specific purpose of going into our PAC so that we have money to use to open doors in Albany on issues that are important to the profession. That started in 1999, and it's still, to be honest, a very fledgling operation that needs to be much more robust in the years going forward. The second bucket in our advocacy area is our staff government relations function. Our general counsel heads that up. Her name is Joanne S, and she works in conjunction with a volunteer legislative task force that's currently, it's made up of all CPAs, and it's currently headed up by a CPA named Kevin McCoy out of our Northeast chapter, who has been very involved in Albany politics through his family relationships that go back generations. The third bucket is our lobbyists. So I am a lobbyist on your behalf in Albany, as is one other staff member here at the Society. And we also hired a lobbying firm. Their name is, its name is Bolton St. John, one of the most respected lobbying firms in Albany. And they work with us as well to help us make connections with legislators, to keep their eyes open on what's going on professional issues, et cetera. And all together, that's our robust advocacy campaign on your behalf. And because we believe it's one of the most important things to do, we continue to put additional resources into it. So what does that mean? It means that every year we develop a legislative agenda on issues that are important to the profession. And they're important to you as CPAs and your firms and your businesses, and also to protect the license that you work so hard to earn. Nobody else is watching out for that for you, and that's why we believe this is so important as a membership benefit. So we come up with a proposed legislative agenda every year that has issues that we're going to focus on, and we present it to the Society's Board of Directors in September. They talk about it, and then during this fall period, as we travel around to all of the chapters, we solicit feedback from you who are out there in the field, in your own geographic part of the state, doing in your own practice areas, to find out if there are other things that we need to incorporate into this agenda that we might not necessarily know about. So this is our 12th chapter visit, and this year we've learned that one of the issues that is important to our members, they fall on the tax side. So we're taking a lot of time to focus in on things like the driver's license requirement, which we'll talk about in a little bit, and other issues that we might not necessarily know that there's consensus about throughout the state. That agenda is then approved by the Board of Directors at its December meeting, and then in January when the session starts, those are our marching orders on your behalf. So I'm going to very quickly go through the 7 or 8 issues that are on our agenda right now, and very quickly because we're trying to get as much in here as possible. On the table right now, there are proposed changes to the requirements for your ethics CPE. How many in here are familiar with the proposed changes? Okay, a couple of you. I'll go into a little bit of detail then. Right now, you need, in order to meet the requirement, 4 credits over your 3-year licensing period. There's now a proposal in Albany from the State Education Department that's going to change that. It's not in effect yet. But what they are proposing is that the new requirement will be 6 credits over the 3-year licensing period that will look like 2 each year, 2 plus 2 plus 2. And the reason why they decided to do that is because they did a survey last year and found that there was only a 50% compliance rate with people taking their ethics CPE, and they thought that the regulation was too confusing, so they wanted to make it very simple, 2 plus 2 plus 2 in each of those 3 years. We took that issue to the Society's Board of Directors. We got some feedback from them in terms of let's go back to the state and see if we can ask for some flexibility with that. So you could take 6 at one time or 4 plus 2, whatever combination. And we're in the process of doing that right now. The other change with the ethics is that right now it all has to be New York-based ethics. Under the new requirements, only 2 credits need to be New York-based, and the others can be anything else, behavioral ethics, etc. So there's a lot of detail about that, and if you follow the trusted professional, you can keep up to speed on it. The other issue is the New York Tax Department driver's license requirement. How many people in here do taxes? Okay, about half the room. So you all know what we're talking about with the driver's license requirement. And when this came to the surface last year, we have an outstanding relationship with the acting commissioner of the tax department. We were able to connect with her very, very quickly, and we were very crucial to the end result from last year, where it had the check-off on the form, where if your client did not provide you with a driver's license, you could check off and file it. This year we found out that the requirement is not going to be voluntary, it's going to be mandatory. And we again connected with her right away and asked if there was any flexibility with that. And she said, no, there's no flexibility. I'm not changing my mind. I have to do this. And here's why. So last year they were able to stop $500 million from being taken out of the system from bad actors because of the requirements that they had in place. So she said she's not going to make it voluntary. It's going to be mandatory. We offered some other options to her, like 2-step authentication. Could we do something like that? And she said that wouldn't work for her. So we're in the process of we're in a conversation mode with her, trying to find out the specifics of exactly what it's going to look like. But this year, you can expect that it is going to be a mandatory requirement. Yes? We did talk to her about that, and she's going to try to adapt that. And there's also going to be, there are a lot of changes that she's proposing. So you will only need 3 of the digits on the license number, with the numbers that are on the back of the driver's license. And for some, as we traveled across the state, we found out that that's problematic for a lot of members because sometimes that number rubs off, that number changes every 3 years. So we're in discussion with her about that in particular. And then there's also another issue that's related to the transfer of last year's information that may have been inputted into your systems already that is not going to be it's not going to be converted at all into the new system. And there are only 3 states in the country, New York being one of them. The other 2 are Iowa and Arkansas, who have that restriction. Everybody else allows that transfer of information going forward. So that is now on our legislative agenda for the next year, hopefully to be approved by the Board of Directors. So the point here is that we've got this relationship with the tax commissioner, and we try to get to a good place for the profession. Yes, Arnett?
It's on file.
Excuse me?
Oh, what about keeping a copy of the driver's license on file?
So that's something that we're recommending. Is there's a lot of vulnerability for CPA firms if they're keeping that additional identifying information. So one of the things that we're looking at the Society right now is forming a partnership, an affinity partnership with software companies that could provide a platform to our small firms and sole practitioners that will enhance their level of security, so that if you're forced to keep that information, you can at least be assured that it's on a more secure platform. And then in addition to that, we're working with Cameco, which is our professional liability insurance company, to say, hey, okay, our firms are now elevated in terms of the security of their platforms. Can we see a reduction in their professional liability insurance? So we've got all those balls in the air at the same time. And again, it's a fast-moving target, so please read your trusted professional for updates. Okay, keeping going. Mandatory peer review. How many people in the room do peer review? Nobody. Oh, one. Okay, two?
No, I did have a question.
Oh, sure. Okay.
No, I just wanted to find out in what way the license requirement is, allowing the department to save so much money, and how do they determine the amount of savings?
They were able, if I understand it correctly, she was able to tell by the driver's license inputted numbers that people were trying to access accounts to take money out when they didn't have all of the identifying information. So because they required that extra piece of identifying information, it didn't match up, and they knew that that was going out to bad actors. And that's just what they caught. She doesn't know what else is out there, which is why she was adamant about not making it voluntary. And when you put your fiduciary hat on, she's responsible for the taxpayers' money. And I think if I were in that position, that would be my response too. I've got to find a way to stop people from breaking into the system. So that's where her head is with that. Okay, nobody in the room does peer review? You were in the peer review area. So I'll do this one very quickly. Peer review in New York State is now mandatory for all firms that do attest work. There used to be an exemption for firms with 2 or fewer CPAs unless they did yellow book work or any kind of government auditing work. That is now changed. The society lobbied for this change to enhance quality within the profession, and it sailed through the legislature, and it was a legislative victory for us. The next item on here, non-CPA firm ownership, has been on the list for many years now, and what this is allowing, New York is the one of only 2 other, there are 2 states in the union that do not allow non-CPAs to have ownership rights in CPA firms. And this has been on our list because our firms increasingly, firms of all sizes, it started with the largest firms, but now it's not just the largest firms, are at a disadvantage in terms of hiring talent that are beyond the CPA profession, that are now crucial to helping to do the best audits when you're providing client service like that. And because of that, other professionals who are not CPAs are leaving New York, and they're finding partnerships with other states, firms in other states that allow them ownership privileges, and it's impacting the talent in firms in New York State. This one has had trouble being passed because although the state Senate has approved it unanimously for 5 or 6 years in a row, there's one legislator on the Assembly side who's adamantly opposed to it. She has a lot of power, and she has stopped it every year. Now, I usually, when I go to the other chapters, talk about estate tax reform, and when I do it, I always give credit to a man that I label our CPA crusader in this regard, and I feel that I am very, very poorly qualified to speak to this issue when he himself is in the room. So, Kevin, would you like to talk for 2 minutes?
The exemption has gone up. It's gone up significantly. It used to be only $1 million. Now we're sitting here, it's substantially higher. It's $5,250,000. But usually when you think of an exemption, how does that work? Well, usually you think of it as like, well, first $5,250,000, whatever that number is, safe haven, no estate tax. Above that, you get the benefit of that safe harbor, and you're only taxed marginally based upon the amounts in excess of it. Not so in New York State. Something completely irrational, at least in my view, is that if you go a little bit above it, New York State takes away the benefit of the exemption. So that if you're 5% above that number, 105% of the $5,250,000, you're taxed from $1. And it actually has a dynamic that it produces a marginal tax rate of way over 100%. I mean, so much so that, I mean, it's an exaggeration, but not really. If someone were to throw money out the window and they were slightly above that, they would actually be saving their family money. How insane is that? You could also use a light the fire illustration, but I don't like to go there. It's too many dangerous consequences. So that's the problem, but there are solutions. Solutions really comes down to just the numerics of it. One way is, okay, so let's say you still have the benefit, you still have New York State desiring to to take away the benefits of the credit. You can do it, though, in a more rational way. You just extend the runway for the phase-out. Because we've spoken with the folks up in Albany, they're inclined to keep this, but instead of phasing out between 100% and 105% of the basic exclusion amount, you do it maybe from 100% to 150%. Yes, it still gets phased out. It does raise revenues, not as much, but it still does raise revenues, but it's done rationally. So the highest marginal rate, instead of being 172%, whatever the figure is from year to year, is closer to maybe 17%, something that's sensible, that we can live with. And that's the essence of our argument. Thank you.
Thank you so much. I knew I couldn't do it any better than that, Kevin. So you're now going to be part of our statewide tour, just to let you know. Tomorrow morning at 8:30. Okay, this last one is an easy one, municipal contingent fee audit report form. So right now, there are non-CPAs out in the field who have been hired by the state to do audits of sales and use taxes and of property taxes. And because those professionals are often they're not CPAs. They're all different kinds of professionals, and there is not a lot of oversight in terms of what they're doing. They work on a contingency basis, and therefore they have no incentive to try to save the taxpayer money in any of these areas, and there are also data protection issues. So 4 states have passed a law saying that they wanted to prohibit that, and we're trying in New York to get this under the purview of a CPA so that those checks and balances are in there because you're licensed to protect the public interest. So that's what that one is about. Stay tuned for that. Voluntary licensure surrender. So this was a byproduct of the accountancy reform law of 2009. When that law was passed, there was an expansion of the scope of services for CPAs. So now pretty much anybody, CPAs in industry, CPAs in education, government, and of course public accounting, are now all under the scope of practice. And this kicked off an unintended consequence in terms of if you're a CPA who no longer wants to be a CPA and doesn't want to practice anymore, you cannot hand back your license. It's against the law and the regulations to hand back your license unless one of 2 things happens. Anybody want to guess? Does anybody know what one of those things would be?
One of them is you die.
You die, right? That's one of your choices. And what else? What else might get you out of being a CPA?
A felony?
A felony, yes. Irama, you know too much about this. So yes, that's the only 2 ways that you can hand back your license, and for some CPAs that doesn't work. So if you don't want to be a CPA anymore, say, this is an example that I use because it drives the point home, say that you decide you want to open up a car wash, right? You want to be outside in the fresh air all day. There's no stress. There's no pressure. You open up a car wash. You get your statement from the state that says it's time for you to register, to send in your check for whatever the registration fee is. And oh, by the way, have you taken your CPE? And you say, I don't want to do that. I'm running a car wash. However, in the accountancy reform law of 2009, there's a 1.5 pages of language that defines the skills and competencies of a CPA, and it includes things like, I'm responsible for payroll. I use spreadsheets, and when you're running your car wash business, you absolutely do that. So technically, you're using the skills and competencies of a CPA, and you have to register, pay the fee, and take your CPE. The only way around that would be if you stole one of those cars that you're washing, committed a felony, and then you would be okay and you would have other problems to consider. So we're working on that as well. Mandatory CPE for all CPAs. What this one is right now when you're newly licensed, you don't have to take CPE for 3 years. And years ago, that was okay, but now the amount of information that is changing and evolving in the CPA profession makes things very old very soon. When you first take that exam, you're the smartest kid in the firm. The day after you pass that, you know that you passed the exam, and you can tell everybody else in the firm everything that you know, but that doesn't last very long. And most managing partners that we spoke with say, well, you know, we do that anyway. We require CPE for all of our CPAs from day one. So this is pretty much a no-brainer. And from a strategic perspective in terms of our legislative agenda, we want to communicate to the legislature that the CPA profession is about quality. So this will send that message. All CPAs should be educated from day one. And also it ties back to our peer review issue, where we said all CPAs who do a test should have a peer review. And if we can communicate to the legislature repeatedly that CPAs equal quality, then we'll have a much easier time trying to pass some of the other legislation that is a little bit more challenging, like our non-CPA ownership. So that is what that one is about. Now this what else at the bottom was originally intended when we put this slideshow together several months ago to solicit, okay, what else? Is there anything else you want us to talk about? However, in recent works, there's been a huge amount of movement on tax reform on a federal level. So we wanted to talk a little bit about what the society is doing in that regard. So years ago, going back into the 1980s with the Reagan tax proposals, the society leadership at that time made a gentle person's agreement with the AICPA that the AICPA would take the lead on national issues and the states would step back a little bit. And the reason why that became a sensible solution was because it was problematic that some combination of the 50 states, not a lot of them, but some of them, including New York at that time, would go to Washington and would lobby the federal legislators on tax reform issues, oftentimes tripping over what the AICPA was doing. So the agreement became that we would work in conjunction with them, but they would take the lead on this. Roll fast forward to 2017, where we are now in terms of tax reform, and that formula is not necessarily working because the AICPA represents the entire country, but there are issues in the House proposal in particular the state and local tax deduction, that the AICPA is not focusing on because they represent all 50 states. But for New York and a handful of other states, it's a huge issue. So what we did is we wrote a letter that was approved by our leadership to the New York House delegation saying this is bad, here's why, and we highlighted 3 or 4 bullet points on that. That letter can be found on our website. And we sent it off to the delegation. Our next step with that is we have 3 members on the Ways and Means Committee, and that's the committee in the House that drives tax reform and tax legislation. 3 of them are New Yorkers, so our next step is to connect with them and communicate our message to them as well. So what the challenge is now is that every morning you wake up and there's something different happening in Washington on tax reform, and it's very hard to keep up with it in terms of strategy. So as we speak now, the Senate plan is probably being voted on, and we've looked at it, and we know the similarities and the differences between the House plan, and right now our communications team is writing a response to the Senate version as well, which we will send out first thing tomorrow morning once we get it through the process, saying the same thing, hey, this is bad. You know, and the Senate version, in terms of implications for New York, is much worse than the House version. So we have a lot of work to do in terms of communicating our message. And it's not just New York that it impacts. So we also formed a loose coalition with the other states, my counterparts in the other states. I think there are 6 of them, states that this impacts. And we decided, okay, there's power in numbers. Let's get all our total membership numbers together and send this message out. And the other states were a little reticent to do that except for New Jersey. So we're working very closely with New Jersey, and we're hooked into the AICPA team to make sure that this message that's going to be so harmful to New York gets out there. So we just wanted to make you aware of what we were doing. Okay, before we shift to our next speaker, and I am right on time, look at that. Any questions on all of those topics that I talked about? Kevin. Thank you. And thank you very much, Kevin. And it talks about the property taxes, and it talks about the mortgage deduction and how many counties already exceed the cap. I think there were 5 counties in New York where the average is well above the 10,000 that they're looking at. So there's some very powerful information. That's correct. The Senate, it's 0. So we have a lot of work to do on that. All right. So, yes.
Hi.
Correct. That's correct. That's the definition of a test in the law. Correct. Yes. No, it's a great question. Anybody else?
Yeah, to follow up on this question, when you providing non-attestation services, I heard somewhere, I don't recall where, that even if you do not provide, if you don't do any audits or anything like that you still have to pay a registration fee to be registered in the system, even though you're not going to be subject to peer review. Is that correct?
I don't think that's, if you don't do peer review, then you would not be part of that peer review program. Because when we no longer do that, we're no longer an administering entity for the AICPA on that, but when we were, we had a list of firms that were subject to peer review, and they were the only ones that were billed by the AICPA for that. So if you want to talk offline about that, about your specific circumstances, I'd be happy to do that, but I don't think so. Okay? All right.
Hi, I have a question. My name's Elisa. I know, and this is probably an ignorant question.
That's okay.
But even if the House and Senate approve this bill, do we know, or do you know what power the president has to add on any more additional agendas? Because right now I know there have been a few extras, such as the church and state, the fact that their political contributions has changed, as well as the right to a fetus getting rules regarding prior to birth. Do you know if the president can actually add after it's been approved?
Well, that's actually, you're the second person who brought that to my attention today, so somebody has been really analyzing that Senate version of the bill, and there are a lot of things in there like that that are really political statements that are being incorporated into the bill. So what happens next in the process if the Senate passes their bill tonight? It goes into conference, and the Senate and the House have to duke out what that final bill is going to look like before it goes any further. And there's a big concern about whether they're close enough to even make that a reality. So let's assume that they're not, then nothing happens. But let's assume that they are. So they got a piece of legislation that incorporates half of this and half of that, and then it goes to the president for signature. And I don't know. I think he has to approve what's sent to him. But this process has been so wild and crazy. Every day we wake up, and it's seriously, every day we wake up and there's something different that we have to follow. So I think the crucial thing that you need to look at is that conference deliberation between the House and the Senate if that Senate bill gets passed tonight or tomorrow morning.
Thank you.
While we're speaking.
The House may say, okay, we'll just go with the Senate version.
Yep.
Waive conference and send it to the president to sign.
That's right. That's right.
Possible.
And that's a danger. Yes. Yes. So stay tuned, ladies and gentlemen. And on that note, I'm going to introduce you to our illustrious president, Harold Deiters, who will take us through the last half hour of the presentation.
One of the true things that the society does for us in our profession is the society is an advocate for our profession. And, hearing all the great things that the society is doing up in Albany just reinforces that. And that's how important that PAC is. So it's great to see that, and I think Joanne did a great job presenting it. So I'm going to cover some more soft topics. I'm going to cover basically the state of the profession, and I'm also going to do some generational stuff. And at the end, I'll add some additional New York statistics if we get there. But I have a half hour, and usually I go about an hour and 15 minutes. So well, we're going to do our best. Okay, so disruption. That's basically the state of our profession right now. We're in a state of disruption, meaning so many things are changing. Technology is going to change everything for us and to us. It's going to actually eliminate some of our jobs. It's going to change the way we do our jobs. Not since the day that the computer came out and accounting programs and spreadsheets were done on the computers have you ever lived through or seen a change that's about to come. Artificial intelligence is right around the corner. It's actually already here. It just hasn't filtered its way down to the accounting profession, but it's coming. So the three factors that drive disruption: smart and digital technologies. I just explained a little bit about the AI. Globalization, the day of having a client that's a local client and doesn't do anything on the global scale. Well, they still exist, but nowadays, how many times do we have a client that starts a website and now all of a sudden is shipping their goods all over the country, if not all over the world? Or a client that always used to have a manufacturing company sell them all their goods. Well, now they want to have their own private label. And they hire a company that's going to find factories overseas, and they're going to actually start manufacturing their own goods. That's happening. New forms of regulation. And when I say new forms of regulation, what I'm referring to is actually new forms of regulation in industries and in technologies that never existed before. And we'll cover that a little bit as well. So let's look at smart and digital technologies. Replacing the manual workforce. such as bookkeeping, supporting trends towards outsourcing some services and repatriating others, automate complex, multifaceted processes. I mean, this is already happening. The technology now, when we get documents and we get information, even if we get it in hard copy, we're scanning it in. The readers are reading the scanned copies and automatically inputting information into our programs. Now, what if you have to, what if you can skip that scanning process? What if the information just can come downloaded right to you? Well, you're eliminating the human side of this now, and the computers and the programs are already there. They read the information, they input the information, they process the information. This is here, and it's replacing jobs. The multifaceted, automatic, complex processes. What I do is I'm a partner in charge of the litigation and valuation group for Baker Tilly's New York business unit. There's a process in which you value a large company using public company multiples. I used to give a staff person an assignment to collect information from publicly traded companies, their 10Qs, their Ks, etc., and derive multiples, price to revenue, price to EBITDA, etc. It would take them about 12 hours. Now, for a small fee, they go onto a website. We pick 4 or 5 publicly traded companies within the industry we want. We press a button, and within 20 minutes, that person has done everything that used to take 12 hours. It's there because everything's automatically put in there. I don't need them to print and then enter. And there's a website out there where they can go and just do this. Now, that sounds great, right? Efficient. They took 12 hours worth of work and put it in 20 minutes. That's not good. I bill by the hour. Think about it. I just lost 12 hours of revenue. Yeah, I have to make up for efficiencies, but I'm going to have to make up that time and that revenue somewhere else. So that's here. That's actually happening. PwC put out a survey every year, and they asked the U.S. CEOs certain questions. And here we see the percentage of U.S. CEOs who expect technology to change the nature of competition significantly over the next 5 years is about 53%. That's significant. And what does that tell you? That's their mindset. And if these large corporations and these U.S. CEOs know technology is going to change competition significantly, what do they want to do? They want to be ahead of the curve. What are they doing to do that? They're spending lots of money on it. And if they're spending lots of money on it and putting lots of people on it, that technology is going to advance even further. I will tell you the Big Four has told us and have said they are spending significant amount of money looking into artificial intelligence and how that is going to change the way we handle our profession and the number of people we need, but then also what kind of people we need in our professions. Knowledge of new models for business funding, payments, and services such as wider blockchain-based applications will be vital to all CPAs. And this is part of the technology. How many people right now are dealing with Bitcoin? Anybody? But we know what it is, right? Or have an idea what it is? That technology is out there. These corporations are now dealing with it, and they're going to their accountants and saying, what do I do? My clients want to pay me in Bitcoin. What is that? How do I do it? But what is also the problem? Well, that's a whole new industry. How is it regulated? I mean, it used to be thought that this Bitcoin thing, well, that's a fad. That ain't going to take off. No one can just create their own commerce. Well, they did. And now it's a multi-billion-dollar industry. And it's going to be affecting all of us because it's going to start to filter down to medium and smaller firms. Expert use of analytics will enable more and better and closer real-time reporting, increase predictive analysis, highlight interconnectedness of financial and non-financial performance. That exists already as well. I can tell you that they have studied companies like Enron, and they went back and they looked at all the financials that were being put out by these companies before they blew up, imploded. And they asked themselves, why didn't we see this coming? Were there any signals? Were there any? Well, they found that there were. Yeah, it's not in your simple current asset to current liability ratio, your current ratio. It might not have been in your profit before tax. It might not have been in how you leveraged your balance sheet. But the ratios were there. You just needed to know how to calculate them. And now they come out with stuff like Z-scores and other analysis. And since all these public companies have to enter all their information into the computer systems, these computer systems are automatically processing it and looking to see if anything, any indicators from these companies that we know imploded exist in companies that are publicly traded right now to try and protect investors. Even greater use of video and social media will provide collaboration, disclosure, presentation, and stakeholder engagement. If you don't have a social media presence in your firm right now, or even as an individual, you're behind the curve. Because the way customers relate to us is through social media and through the internet. If there's a client out there that's looking for a new accountant and they're being introduced to you, before they meet you, chances are they went to a website, went to a search engine, Google, Bing, any one of them, and typed in your name or typed in your firm's name, and they wanted to see what came up. If you haven't put in your own personal name in a search engine in the last 2 weeks or month, do yourself a favor. When you get home tonight, not now because I'm talking, put your name into a search engine and hit enter and see what happens. I hope you're happy with what you see, because that's what others are seeing about you. Put your firm's name in there. What comes up? What do they see? Anybody hear of a website called Glassdoor? Glassdoor is a website that collects information from employees about the companies they worked for or work for now, about their bosses, about the environment they work in. Is it a good environment? Is it a nurturing environment? Do they hate their bosses? And I will tell you from personal experience, hatred is a much stronger feeling than feeling good about your job. And people that hate their jobs want some way to voice that. They want a venue to go and release all their anger, and they go to these websites and they do that. Unfortunately, the people that are happy don't. So it's not good, but you might want to know that. I will tell you, one of the stores out in Long Island, PC Richards, and I know there's some in Manhattan as well. I'm friends with this manager over at Stony Brook's PC Richards store. And when I walk into that store, one of the first things he always asks me is, can you please come right over here? He has it set up, a laptop. Could you go in and put in a review about this store and about PC Richards? He wants me to post on one of the social media websites my experience in shopping at PC Richards. Now, I've been there enough, and he's a good friend. I'm happy to do it. But he's asking actual customers as well that he doesn't know as well, after they've purchased something and they've had a great experience, if they'll do that. Why is he doing that? Because PC Richards understands the importance of social media footprint. And when people go on to Yelp, when they go on to this or they go on to that, they know PC Richards is selling TVs and things that you can go onto the internet and buy, and it's a commodity and you're price checking. But when you go to the reviews of this company and you see these people really know what they're talking about, these people went over and beyond, et cetera, well, then you're more likely to use them. And it's the same thing with our profession. I'm explaining this to you so, and hopefully it's hitting home, that there are things like this that we can do in our own practices that will help generate a better social media footprint, a digital world, and we have to be in it. Okay, there's another website called willrobotstakemyjob.com. It's a real website, and the way it's designed is if you go into it and you type in the name of your profession or your job, it will give you the likelihood that your job will be replaced by a robot in the next 10 years. So how many people here prepare tax returns? About half the room? That's good. So we typed in the word tax preparer, and it told us that 99%, there's a 99% chance that your job will be replaced by a robot in the next 10 years. Congratulations. But no, don't worry about it. There's good news later on. But this is serious. And if you think this is a joke, let me give you a quick example that I think we can all relate to. Last year, I'm sure all of us saw the commercial of the person sitting at an IHOP or a diner of some kind of restaurant, and they took out their phone, and they took out their W-2, and they snapped a picture. And they took out their 1099, and they snapped a picture. And they took out their 1098, and they snapped a picture. Then they looked at their phone, and they hit process. It did some processing, and then they clicked return, file return, and it said, congratulations, your returns are filed. Bang. That's how easy it is. Now, a lot of us are probably sitting here going, well, wait a second. Those aren't my customers. Those aren't my clients. My clients are more sophisticated. Well, yes, but technology is there. And more information is being inputted into the government. I'm waiting for the day where the government's tax reform is this. Instead of saying we're going to let you file on a postcard, they're going to send you an email that says, we've already processed your return. Congratulations. We're going to be depositing this much money as a refund or taking this much money out of your bank account on April 15th. Because the technology is there. There's also other things that we combat besides robots, and that's other competition in the workforce. I was at the NYSSCPA council meeting, and somebody stood up and gave a testimony about how they had a $100,000 client, all tax preparation work, sophisticated, multi-states, $100,000 a year. And their client calls them up and says, hey, Bob, I'm not going to be using you anymore. I've moved my account somewhere else. Well, Bob's upset. Bob's like, what do you mean? I've been your account for 20 years. Why are you leaving me? Well, I found somebody else, and I think I'm going to be better off there. Well, can't we go to lunch? Can't we sit down? Can't we talk about it? Well, I really don't see it's going to make a much of a difference, but if you want, I'd be happy to meet with you out of courtesy. We've been together for 20 years. Well, tell me why you don't think it's worth it. Well, here's the thing. I was looking for a financial advisor, and I have one, but I was looking at new ones. I was thinking about moving my money, so I was interviewing 2 or 3 of them, and I went to my existing financial advisor, and I was about to move my money, and I told him this. And you know what they said? They said, well, listen, stay with us. We really love your business. We're really good for you. Who does your tax work? How about having us do your tax work? We'll do that tax work for you. Well, Bob's like, well, but you want your financial advisor to do your tax work? I'm a CPA. This is what I do. Yeah, don't worry about it, Bob. They have CPAs. They have tax attorneys on staff, too. Well, but Bob's like, but how much are they charging for this? Well, that's the thing, Bob. They're not. They're doing it for free, as long as I don't move my money. So now, by a quick show of hands, and I think I can count this real quick, how many people want to compete with free? No hands went up. No hands went up. Okay, I don't want to compete with free either, but this is really happening. So these things are happening, and we got to be prepared, and we got to make adjustments in the way we do our business. All right. Oh, hold on. How many auditors do we have in the room? All right, we got a handful. I don't want to think I left you out. So we took the word tax preparer out, and we put in the word auditor. I don't have a slide for it, but trust me, your job is almost as secure as the tax preparers. There's only a 94% chance that your job will be replaced in the next 10 years. Okay, so that's a little update on technology and the things that we're going through in the workforce in our profession as a CPA profession that you might want to be adjusted to. Let's talk about the 300-pound gorilla in the room. What is one thing that every person in this room has in common, no matter what size of firm we have? Isn't it really difficult, and don't we spend a lot of time retaining staff? How much does it rip your heart out when a 5-year person comes into your office after they've passed the CPA exam, which you helped pay for, after giving them time to take it, and after the 5 years of training that you've given them, where they've finally turned the corner and you're going to actually start making money, and they say, I'm giving notice, I quit. And you're sitting there going, but why? Why are you leaving me? Are they leaving you for a competition? Are you going to a competitor? Are you going to private industry? What are you doing? Well, we're going to talk about some generational training that hopefully will help you keep those staff members. Now, what's going on right now in the industry? We have 4 different generations all trying to work together. And it used to be, a long time ago when I first got into the industry, it was, we do things this way because this is the way we've always done it, and this is the way we're going to do it because it's always worked. That's done. We have 4 very distinct generations right now in our workforce, and we got to learn how to relate to each other. And not just to each other in our office, but also our clients. So let's talk about that, and let's see what we can learn. Baby boomers. 55 to 71. They are hardworking, no doubt. Motivated by position, perks, and prestige. That's their motivation. They relish work weeks. They relish it. They want it. They self-define themselves by the success that they experience in their professional careers. That's how they judge their life, how successful they are in their professional careers. These are the baby boomers, 55 to 71 years of age. They're loyal. They're loyal to customers. I'm sorry. They're loyal to firms. They're loyal to name. They're loyal to brand. They'll start with a company and stay with a company 20 years. Even though there may be rough spots, even though they know they may be able to make more money somewhere else or be happier somewhere else, they're going to stay because they're loyal to that company, because they're loyal to brand. They're the second largest demographic group after millennials. Here's a problem. They're the oldest, and they're the second largest. The next one underneath them, age-wise, are Generation X. And under Generation X are the millennials. Millennials are the #1 largest group. What about those Generation Xers? What about us? Come on. Did you forget about us? No, I didn't forget about you. Let's talk about the Generation Xers. All right. By quick point, when I went to training on the different generations and I attended classes, what occurred to me and what I learned is each generation is molded, is developed by what they experienced as children, what they saw their parents go through, what they grew up in, sort of affected and changed who they were, whether they realized it on a conscious or subconscious level. So let's talk about Generation Xers. Independent, resourceful, and self-sufficient. They value freedom and responsibility. You give a Generation Xer an assignment, a challenge, they're going to take it and they're going to go back to their office, they're going to close the door, and they're going to work on it, and they're going to work hard on it, and they're going to appreciate the freedom and the responsibility you're giving them to do it. They don't want to be micromanaged. They can work in groups, but that's not important to them. They're not looking to collaborate. They want the freedom, and they want the responsibility. They want the task. They want the job. They have a casual disdain for authority. Here you go, right here. I'm not going to ask for a show of hands, but I'll give mine. Casual disdain for authority. They're loyal, not to firm or brand, to individuals. That is a huge distinction. If you're trying to keep your Generation Xers, the 35 to 55-year-olds, from leaving you, and you're selling them on brand and name, and the firm is good, and the company is good, and the company's been here a long time, they're not loyal to that. Why? Well, what happened to the baby boomers? The 55 to 71s that were loyal to brand and company and corporations. They would stay somewhere for 20 years, right? And then when they were about 10 years away from retirement, what did a lot of those corporations do to those baby boomers? Knocked them out, kicked them out, showed them the door. They're done with them. Their kids saw that. They changed their loyalties. They saw the pain and the aggravation that their parents went through. They didn't want to be loyal to brand anymore. They'll move around, but they will stay for individuals. If you have a Generation Xer, 35 to 55-year-old, connect with them on a personal level, on an individual level. If they respect you, they'll work harder for you. They're less likely to leave you. When others are leaving, they'll stay because you stay. The downside is to your firm, if you leave, they may leave with you. But that's your firm. Loyal to individual, not a firm. Boomers are slow to retire. This is creating a big problem for the Generation Xers. The Generation Xers are left now to compete with the millennials. So you got the baby boomers, they're 55 to 71. They're living life. These are CPA partners that have been around for a while. They're 55 to 71 years old, and life is good. They got the staff that they've always wanted. They've got them trained. They got a reputation, a good reputation in the marketplace. The phone's ringing. People know their name. People know their phone number. They're not working as hard. They're making more money. Why would they want to retire? Well, I'll tell you why they want to retire. They want to retire because the Generation Xers are ready to come in and take on that responsibility. And what's happening to a lot of firms is those baby boomers don't want to retire. So then the Generation Xers are feeling squeezed out because the millennials are coming up underneath them. So the Generation Xers are leaving. Fast forward a few years later, the baby boomers all of a sudden decide that they do want to retire. Well, now the Generation Xers are gone, and they're looking down at the millennials going, you're not ready yet. I want to retire now, so maybe I should find someone to buy us and merge in and do an acquisition. And a lot of CPA firms have been doing that. And then that creates a problem in those CPA firms, now how they're going to fund all those retirements. But the Xers are starting to feel a little squeezed out because of the millennials. So here we are with the millennials. I have had a lot of jokes thrown at me about millennials. We all love our millennials. They're 20 to 34, and yes, they're all ready to be their own boss. They're ready. We should all leave. The millennials are ready to take over because they know better than everybody else. And they'll let you know it. They value collaboration. Remember the Xers? Xers, I said, give them something, they're going to go off, and they're going to value that freedom and responsibility and want to take charge and do it. The millennials, you give them that same task, they're going to go out to the floor where all those other staff members are sitting, and they're going to say, does anybody want to work on this with me? Let's do this together. They like collaboration. So if you have an assignment where you think it's a single person assignment, give it to a Generation Xer. If you have an assignment that you can see being done by a group of people in a collaborative environment, letting them go sit in a conference room maybe, give it to a millennial. Use their strengths. Look for their strengths. They want flex time. 9 to 5 is burdensome. Burdensome. They want to be able to come and go as they need to. Some because of family, some for other personal reasons. One person I've asked because he wanted to go home and play with his dog. I don't even have to make this stuff up. They value frequent feedback. All right. So on the flex time, let me talk about that for one more moment. I'm a big believer in flex time. As the partner in charge of litigation group here in New York for Baker Tilly, I have staff in Manhattan and in Melville, and they have flex time. If I get emails from some of my staff saying, I need to leave at 2 o'clock, my daughters have a swim meet. I'm like, go. I said, but here, I always say, thank you for letting me know. Absolutely, get out of here. Make sure you leave on time. Do not be late for your daughter's swim meet. And tomorrow morning, when you come in, the first thing you do is you come into my office and you tell me how they did. Because I truly am. I want to know how your daughters did. Go enjoy that time. That staff person appreciates that. And you know what? I'll tell you, after the swim meet, after bringing her daughters home, after cooking dinner and taking care of everything else, she's going to get her work done. I don't have to tell her that. I know the work gets done. I see her log in sometimes at 9, 10 o'clock at night, going back in, getting the work done. But they appreciate the fact that they're able to come and go when they need to, but they'll get the work done. And they'll work harder for you, and they're dedicated to the individual, to you, and they appreciate that. They value frequent feedback ad nauseum. It used to be when I got in the profession, you get reviewed annually. Then it was you got reviewed semi-annually. Then you got reviewed quarterly. Then you got reviewed every time you spent more than 40 hours on a job. How about I want to be reviewed every day? Can you walk by and just tell me how I'm doing? Am I doing good today? I need to know. Because I don't know if I'm doing good if you don't tell me. The truth is, it's not. Some things are simple and easy. Some things are simple and difficult. This is at least simple and easy. It's simple to know they value frequent feedback, and it's easy to give it to them. When it comes time to give bonuses, I'm all about money. I'm an Xer, and I relate very well to the baby boomers. I relish long work weeks, especially as the president. Here I am, 15 hours a day. Anybody want to sign up? And I have to be at Staten Island tomorrow at 8. When we, or when firms give bonuses, and you're sitting in that room and the partners are deciding, you know, listen, October 15th was great. Certain people went over and beyond, and we want to give bonuses. We want to recognize that. I'm all for that. I think money is valuable, and they do appreciate that. But ask yourself this. All those people that you're willing now to cut a check and give money to, when was the last time you walked by their desk and said, hey, great job. Thank you. I appreciate you coming in this weekend. I appreciate you getting this job done. I know you were here late. It doesn't have to be big. It doesn't have to be significant. You don't have to spend a half hour with them. You can just walk over, say something really nice, and continue on. What you've done is you've energized them. They're going to continue to work harder. You've now connected with them. They really appreciate that. It used to be you never gave compliments like that, and I think the fear was, well, if I say good job, what are they thinking? Well, give me a big bonus check and make me partner. But they just want the frequent feedback. They want to know how they're doing, and as long as they know they're doing well, they're going to keep working hard. Now, don't think for a minute, well, I give out a lot of compliments every single day. Every time someone walks in my office, I basically say, thank you for walking in my office. I'm also very quick and on top of them if they need to be reprimanded in a good way, in a constructive way. If they step out of line, they need to know that. They value the feedback. It doesn't have to be all rosy and always cushiony. If they need a no, you did good, but I need you to do better, you can do that too. They just enjoy. They want the free feedback. All right, let's talk about Generation Z. Love Generation Z. If you're not ready, get ready, because here they come. The teens and early 20s, and I'm not sure how they're going to do in the workforce yet. I'm really interested to see how this works out. They're post 9/11 generation. So I have a 14 and a 16-year-old. They grew up post 9/11. My son, who's 16, was born in January 2001. So he was about 9 months old when 9/11 happened. They grew up during the Great Recession. They're digital natives. I swear to you, I think babies are born with a cell phone in their hands. And if they're not, when they get home and they're put in the crib, a cell phone is put in there with them. And it's probably playing some lovely jingle music or something to help the baby go to sleep. And as soon as that baby's old enough to hold the bottle in one hand and a cell phone in the other, that baby's doing it. They're entrepreneurs. That's their spirit. That's their mindset. They're always looking. They want to be entrepreneurs. You can capture that. You can challenge them. Help them to find ways to be an entrepreneur for you and your firm. Give them that challenge. In addition to the billable hours you need them to do, give them a challenge on ways to grow your practice. Give them a challenge on ways to market your firm. They can relate to this generation. They can relate to the millennials. They can help you, but all you have to do is ask. They want to do it. However, they do have a short attention span. So I give this example a lot. I walked into my house. My 16-year-old son's at the island. He's doing his homework, his math homework. It's around 9:30, 10 o'clock at night. I'm just walking in from work. And I look at him and I say, hey, Anthony, what's the matter? Why are you still up? Dad, I'm doing my math homework. I'm like, okay. Why are you still doing your math homework? I haven't finished and I'm working on it. So Anthony's sitting at the island, and right here is his iPhone, propped up with a YouTube video playing on it. I can assure you it had nothing to do with his math homework. Over there in the corner is Alexa, playing some rap music. Not my kind of music, but it is his. In front of him is his laptop, and in front of him is the hard copy paper math homework he's supposed to be doing. So a good dad, as I am, I walk in, I say, okay, Aunt, I'm going to help you out. I take the phone, I turn up the YouTube, I place it face down. I say, hey, Alexa, shut up. And actually, it does work. It immediately stops. I take the laptop, I close the screen. I say, there you go, son. Now focus on your math homework. I walk over to the corner. I start cleaning up something. I'm looking back over him, and he's sitting there like, I'm seeing him struggle, and he's looking, and he throws the pen down, exasperated. I'm like, Aunt, what's the matter? I can't focus. Okay. But this is what they're used to. They're used to inputs coming from all areas. They almost need that distraction. My wife literally was having a fight with him while I was on the phone with her on the way here tonight because he felt he could only do his homework if he was sitting in front of the TV, with the TV on. Think about the fact that when you walk through your office, what do these millennials, and if you have any Generation Zs at your office already, what do they already do? What do they have in their ears? Earbuds, earphones. Listening to podcasts, listening to music, all of them. You have 3 screens now, right? Everybody has 3 screens because you've got to be 300% efficient. The screen on the left has the YouTube video, the screen on the right has the emails, and the screen in front is the front screen you're working on. But this is how they work. You don't even bother trying to take it away anymore. As long as they're productive and they get their job done. But if you know that, that's important. I want to go back to millennials for a second. I forgot this. I love this part of this. 79% when surveyed say that work environment is more important than money. More important than money. Okay, I'm going to say at this point I don't relate. But work environment is more important than money. And I'll tell you, I'm fortunate enough to work for a big firm. We survey all our employees, almost 3,000 of them. And you know what happens with the millennials and when we get the surveys back? This is what they really say. Work environment. You know what they want? They don't say, give me more money. Can we get better snacks in the snack room? Can we get a latte machine? I got one for you. Can we get a kegerator in the snack room, in the break room? A kegerator. Well, many of the partners voted for that. We've decided against it. But this is what is really important to them. This is what they want. They want a more comfortable environment. They want what? Look real quick at what these pictures tell us. Do you notice anything? Look at the baby boomer. Just look at the picture of the individual. Generation Xers, professional. Millennials, a little more casual. All right, I don't know why the Zs are dressed in a suit. I don't necessarily agree with that. But I will tell you, many firms have gone to a dress for the day environment. What is dress for the day? If you're going to see a client and you need to be in a suit, you wear a suit. If you're not going to see a client, if you don't need to be in a suit, go ahead. Come in comfortable. Wear jeans. Wear a shirt. My firm, wear jeans, a collared shirt. We still like you to wear shoes. Please have no holes in anything. But otherwise, come to work comfortable. It's important to them. They like it. I do it. When I started, every day was suit day. Then one day, they said, for the summer, we're going to have business casual Friday. Then we went from business casual Friday during the summer to business casual every day. Then they went to sort of a Saturday casual on Friday during the summer to a dress for the day every day. And it works if you regulate it. And I'll come to work in jeans and a collared shirt and a pair of shoes. And one of my partners once said to me, he said, how could you even do that? He was a baby boomer. And I looked at him, I said, how could I not? How could I expect our staff to feel comfortable enough to come dressed in jeans, shoes, and a t-shirt and a collared shirt like I am today if me as their partner and their boss doesn't? They have to see that it's acceptable and it's okay. And then they'll feel more comfortable and their environment's better. So there's some generational training. I know I'm at my time. I don't get to go through all the other beyond the spreadsheet stuff and New York statistics. Is there any questions on the generational, the AI, the technology, that kind of stuff? I mean, what I'll close with is I gave you a lot of depressing stuff about a lot of things that are happening and how it's going to change your industry and how 99% of the taxpayers aren't going to have jobs in 10 years and 94% of the auditors won't. What does that mean? Well, there's other things that we can do. I will tell you the Big Four shared that they're hiring about the same number of people this year as they did last year. But a big difference is the dynamics of those people they're hiring. If you look at the number of people that come out of college as accounting majors, about 50% of the people they're hiring now have come out of college with an accounting degree and are working towards being a CPA. The other 50% are not. There are other types of majors: marketing, finance, international, etc. I mean, they know and they see non-CPAs in CPA firms are going to become essential because the services that we have to provide our clients go beyond saying, it's that time of year, here's your tax return, file the e-file authorization for me, see you next year. It's getting to know your clients a little better, connecting with them, getting to know their industry a little better. You can do that real easy. You can go on a website. Some of them are free. There's a First Research, which is a fee-based one. I use that for valuations all the time. For a small fee, they'll give you like a 64-page report on any industry you can imagine. It gives you opportunities, weaknesses, challenges. It gives you financial ratios so you can compare it to the, your client. It gives you valuation multiples from done deals and Pratt stats. It gives you all of this information. You read that before you go meet with your client. You sit down with your client and say, hey, listen, what are some of the challenges that you're going through? What are some of the things that you want to do? I was looking at your industry, and I have other clients like this, and you start reciting some of the stuff you read before you met with them. What have you done? You've now become a consultant, an advisor. You know what will probably happen, and what actually has happened? 2 months later, they're going to be sitting, and they're going to think, you know what? I remember what my accountant told me. They're going to give you a call, and they're going to say, remember when we were talking, and you said something about something? Well, I'd like to look into that further. Can you come back in? Can we have a further discussion about that? Can you help me? And now you've made that connection, so when others want to come in and try and take that tax work, they're not going to leave you. But now you're becoming a trusted business advisor. You're becoming more important than just someone that inputs numbers and lets a computer do it, because the artificial intelligence, that's what that's going to do. There are ways around it, and I'll tell you what I have seen, and I didn't get to go through the statistics. If you look at the different areas of accounting, consulting revenue grew this past year by 11%. Tax was relatively flat, and audit was slightly up, and that's due more to the regulations that are happening, and the more that the auditors have to do. So it isn't all doom and gloom. There's a lot of positive there. But the message I have for you, and what I think you should take away from this, is we just got to start thinking a little differently about how we do that. Use the generational training and thinking on how we relate to our clients as well as our staff. So I'll close with that. I don't want to go any further. I know we only had an hour. I really appreciate your patience. I know I went about 5 or 6 minutes over. I'm going to stay up here and hang out for as long as you guys want. If you have any questions, please feel free to come up. But I really appreciate you coming out. I hope you found this valuable in this format, something that you liked. If you did, let us know. If you'd like to see something different, let us know. I mean, truthfully, this takes a lot of work. But we're trying to push out something and give something back to you that we think you would find helpful and useful to bring back to your practices and help you there. So thank you very much, and have a good night.